In a previous lecture, we talked about universal life in terms of a mortality charge. And we emphasized that the mortality charge is a very, very important component of universal life in that really, what is it actually going to cost to insure this individual? So if your client is going to be insured for $500,000, what does it really cost to actually insure that individual? Well, that cost is what they call the mortality charge. Okay, that mortality charge, of course, is based on the age of the individual, the sex of the individual, smoking status, basically. So age, smoking status, and gender are drivers, basically. And the last one, of course, is the face amount, the amount of actual amount of insurance. So if it's $500,000, obviously, then it will reflect that kind of premium. So the whole what we call net amount at risk is really what we're really talking about here, and that's how they actually work out the mortality charge. Now, that all said, there are two kinds of mortality charges that insurance companies will have, what we call yearly renewable term, or commonly known as YRT, or level cost of insurance. And level cost of insurance also, sometimes you may see the word T100, term to 100, next to it or something. So therefore, what it basically means is level cost of insurance, the price is fixed. So if the price is, let's say, $500 a year for $500,000 worth of coverage, it'll be $500 forever and ever and ever. Remember, this is permanent insurance. So that level cost of insurance, the premium never actually increases. Once it's fixed at your particular age, smoking status, and gender, it will be automatically that same price year after year after year. So you never have to concern yourself with the increasing premiums. On the other side of the equation, of course, yearly renewable term. Yearly renewable term is exactly that every single year the actual price will increase because, as we often say, death is relentless. So as you get older, because you are getting closer and closer to the grave, you might say, then obviously the risk is much higher. So the insurance premiums on the YRT will reflect that increase in mortality charge. So to illustrate that point, I've drawn here a graph for you so you can see the two plans together. And we have the actual premium the client is going to pay on this side here, and how long the coverage will go for over here. So if you look for a moment at the YRT cost of insurance, you can see that we may start off at a lower premium. So for example, if your client is giving us $1,000, let's say a year, just to keep it simple, and the YRT is, say, $200, that first year is going to cost $200 to insure this individual for that $500,000 worth of coverage. However, a year down the line, it's probably gone up to $300 and so on. So every single year, this continues to go up because, like I said, death is relentless. So what you have to look at is that what you've got is an increasing cost of insuring you for that same $500,000. So the problem you run into with the YRT is that if the cash value in the policy, and remember that cash value consists of all the premiums that you're putting in, along with all the investment money that's actually being generated for you. If that pot of money, if the cash value pot, does not keep up with the actual increases in the cost of insurance, your client is going to be asked to pay more money. In other words, their premium is going to go up. So even though you might have started off at a premium of, say, $1,000, you may find that because of the fact that the YRT continues to go up, what you'll find is that at some point, if the investments do not keep up with the actual increase in the YRT, what will end up happening is your client is going to end up having to pay more premium. Otherwise, the policy will in fact lapse. To mitigate that problem, some consumers say, I don't want to have this YRT, in which case then you have what we call term to 100 or level cost of insurance. So here, as you can see, the premium will always be the same. So if this is $500, it'll be $500 forever and a day. So using level cost of insurance, the actual account value is not as important. The investment component is not as critical as it is for the YRT, because this is fixed all the way through. The YRT actually goes up every single year. So as a result, you have to be very, very careful that you manage this product properly to make sure that the policy doesn't lapse. Otherwise, your client will, in fact, be asked to pay more premium.